National Test for Agency Listing Agreements 4.1 b. The laws of agency, or in some states, by statute. In every state, a body of law, generally called the law of agency, defines and regulates the legal roles of this relationship. While the relationship is subject to contract law, agency law dictates how the relationship will achieve its purposes, regardless of what the listing contract states. 4.2 c. The relationship is independent of any compensation arrangement. It is important to understand that the agency relationship does not require compensation or any form of consideration. Nor does compensation define an agency relationship. A party other than the principal may compensate the agent. 4.3 c. The defaulting party may have a financial consequence. Involuntary termination of the relationship may create legal and financial liability for a party who defaults or cancels. For example, a client may renounce an agreement but then be held liable for the agent's expenses or commission. 4.4 b. Present all offers to the principal regardless of their amount. A conventional listing agreement does not authorize an agent to obligate the client to contracts, and it does not allow the agent to conceal offers to buy, sell, or lease coming from a customer or another agent. Further, since a client relies on a broker's representations, a broker must exercise care not to offer advice outside of his or her field of expertise. 4.5 c. Confidentiality. The confidentiality standard is one of the duties that extends beyond the termination of the listing. At no time in the future may the agent disclose confidential information. 4.6 d. Comparable to that of other practitioners in the area. The agent is hired to do a job, and is therefore expected to do it with diligence and reasonable competence. Competence is generally defined as a standard of practice equal to the level of real estate marketing skills and knowledge of other practitioners in the area. 4.7 c. Disclose the information to the seller. An agent has the duty to inform the client of all material facts, reports, and rumors that might affect the client's interests in the property transaction. This includes the agent's opinion of the property's condition, information about the buyer's motivations and financial qualifications, discussions between agent and buyer regarding the possibility of the agents representing the buyer in another transaction. 4.8 a. The Andersons. Since Gary executed an agency agreement with the Andersons, they become the client and the Lincolns the customer, regardless of who pays the commission. 4.9 c. A broker who has an agency relationship with a client. In a subagency, a broker or licensed salesperson works as the agent of a broker who is the agent of a client. Subagents might include a cooperating licensed broker, that broker's licensed salespeople, and the listing broker's licensed salespeople, all of whom agree to work for the listing broker on behalf of the client. 4.10 b. One agent represents both sides in a transaction. Dual agency means representing both principal parties to a transaction. The agent represents both buyer and seller or tenant and owner. 4.11 c. Disclosing material facts that affect the value of the property to both parties. In the role of facilitator, the broker's only fiduciary duties and standards of conduct are those of accounting, skill, care, and diligence, honesty and fair dealing, and disclosure to both parties of all material facts in residential sale transactions affecting the property's value. Some states do not allow for this form of relationship in a real estate transaction. 4.12 a. The agent is showing the client's property to a prospective buyer. Agency disclosure must occur upon substantive contact between the listing agent and a customer. Examples of substantive contact include showing the prospect a property, eliciting confidential information from a prospect regarding needs, motivation, or financial qualification, and executing a contractual offer to sell or lease. 4.13 d. Trust, confidence, and good faith. The essence of the agency relationship is trust, confidence, and mutual good faith. The principal trusts the agent to exercise the utmost skill and care in fulfilling the authorized activity, and to promote the principal's best interests. The agent undertakes to strive in good faith to achieve the desired objective, and to fulfill the fiduciary duties. 4.14 b. General. In a general agency, the principal delegates to the agent ongoing tasks and duties within a particular business or enterprise. Such delegation may include the authority to enter into contracts. 4.15 b. Special. Under a special agency agreement, the principal delegates authority to conduct a specific activity, after which the agency relationship terminates. In most cases, the special agent may not bind the principal to a contract. Real estate brokerage is commonly based on a special agency. 4.16 c. A party creates an agency relationship outside of an express agreement. An agency relationship can arise by implication, intentionally or unintentionally. Implication means that the parties act as if there were an agreement. For example, if an agent promises a buyer to do everything possible to find a property at the lowest possible price, and the buyer accepts the proposition, there may be an implied agency relationship even though there is no specific agreement. 4.17 a. Condemnation of the property. An agency relationship may terminate contrary to the wishes of the parties by reason of death or incapacity of either party, abandonment by the agent, condemnation or destruction of the property, renunciation, breach, bankruptcy, or revocation of the agent's license. 4.18 a. The agent has violated the duty of confidentiality. An agent may not disclose any information that would harm the client's interests or bargaining position, or anything else the client wishes to keep secret. The confidentiality standard is one of the duties that extends beyond the termination of the listing. At no time in the future may the agent disclose confidential information. 4.19 b. The agent has not violated fiduciary duty. Since it is illegal to refuse to show buyers the property based on where the buyers live, the agent has not violated fiduciary duty. The duty of obedience only applies to legal activities. 4.20 d. Inform the seller. An agent has the duty to inform the client of all material facts, reports, and rumors that might affect the client's interests in the property transaction. 4.21 a. Prior to completing a listing agreement. An agent who intends to represent a seller or owner must disclose the import of the proposed agency relationship in writing before the listing agreement is executed. 4.22 c. Whenever substantive communication is made beyond casual conversation. A listing agent must disclose in writing to a buyer or tenant that the agent represents the owner in the transaction. This disclosure must occur before or at the first substantive contact with the customer prospect. In some states, buyer representatives must disclose the agency relationship to sellers or their agents upon initial contact. 4.23 b. Upon initial contact. A buyer agent must disclose the agency relationship to the seller or seller's agent on first contact. Substantive contact is assumed to occur immediately in this circumstance. 4.24 a. May not represent one party's interests to the detriment of the other. A dual agent's first duty is to disclose the agency relationship to both principal parties or to withdraw from one side of the duality. After disclosing, the agent must obtain the written consent of both parties. If both parties accept the dual agency, the agent owes all the fiduciary duties to both parties except full disclosure, undivided loyalty, and exclusive representation of one principal's interests. 4.25 d. Practicing law without a license. An agent should not act or speak outside the agent's area of expertise. A customer may rely on anything an agent says, and the agent will be held accountable. For example, an agent represents that a property will appreciate. The buyer interprets this as expert investment advice and buys the property. If the property does not appreciate, the buyer may hold the agent liable. 4.26 a. Fiduciary and contractual obligations with the client. A listing agreement establishes an agency relationship between agent and client that commits the agent to the full complement of fiduciary duties to the client in fulfilling the agreement. 4.27 d. Market, sell and show the property. Special agency limits the scope of the broker's authority to specific activities, generally those which generate customers and catalyze the transaction. A special agency agreement usually does not authorize a broker to obligate the client to a contract as a principal party. Normally, principals do not delegate the authority to negotiate price to an agent in a residential transaction. 4.28 b. An implied agency may have been created, with obligations to perform for both seller and agent. Clients and agents may also create an implied agency listing based on substantive actions rather than on an express agreement. For example, if a seller allows a broker to undertake certain activities toward effecting a transaction without a specific authorization, but with full knowledge and consent, an implied agency may have been created. 4.29 a. The agent cannot assign the listing agreement. Since a listing agreement is a personal service contract, it is not assignable. In particular, a broker cannot assign a listing to another broker. 4.30 b. Exclusive right to sell. The exclusive right to sell listing, or exclusive, gives the agent the most control over the property and the greatest likelihood of being compensated for his or her marketing efforts. 4.31 c. A listing that is entered in a multiple listing service to enable cooperation with member brokers. Though not a distinct type of listing agreement, multiple listing is a significant feature of brokerage practice. Multiple listing is an authorization to enter a listing in a multiple listing service. 4.32 b. The customer must be legally competent to undertake the transaction. Effecting a completed transaction means finding a customer who is not only ready, willing, and able, but one who makes an acceptable offer. A ready, willing, and able customer is one who is amenable to the terms of the transaction, ready and willing, and is financially capable of paying the price and legally capable of completing the transaction, able. 4.33 a. Obtain and distribute compensation. In the normal course of business, a listing broker delegates marketing responsibilities to salespeople. A salesperson may not, however, seek compensation directly from a client. Only the broker can obtain and disperse the compensation. 4.34 c. Peri, since he found the customer. The two principal determinants of procuring cause are being first to find the customer, and being the one who induces the customer to complete the transaction. 4.35 d. It may be terminated against the agent's will. A listing may terminate on grounds of performance, infeasibility, mutual agreement, revocation, abandonment, breach, lapse of time, invalidity of the contract, incapacitation of either party, destruction of the property, or, in this case, involuntary title transfer. 4.36 b. Sue the broker for money damages. If the broker cancels the listing or otherwise defaults, the client may sue the broker for money damages. 4.37 b. Exclusive agency agreement. An exclusive agency listing authorizes a single broker to sell the property and earn a commission, but leaves the owner the right to sell the property without the broker's assistance, in which case no commission is owed. 4.38 c. Open listing. An open listing is a non-exclusive authorization to sell or lease a property. The owner may offer such agreements to any number of brokers in the marketplace. With an open listing, the broker who is the first to perform under the terms of the listing is the sole party entitled to a commission. 4.39 d. Net listing. A net listing is one in which an owner sets a minimum acceptable amount to be received from the transaction and allows the broker to have any amount received in excess as a commission, assuming the broker has earned a commission according to the other terms of the agreement. 4.40 a. The client. Generally, buyer and tenant representation agreements are subject to the same laws and regulations as those applying to owner listings. The only difference is the client and his or her transaction expectations. 4.41 A. To list the owner's property in a multiple listing service. A multiple listing is not a distinct listing contract but rather a provision in an exclusive listing authorizing the broker to place the listing into a multiple listing service. A multiple listing service is an organization of member brokers who agree to cooperate in the sale of properties listed by other brokers in exchange for a share of the broker's resulting commission. National Test 5, Brokerage Business, Sale Contracts 5.1, D. Nonprofit Corporation. A nonprofit corporation is a corporate entity which is not legally entitled to generate profit. A nonprofit organization may not broker real estate. 5.2 C. Are properly licensed. A joint venture is a partnership formed to complete a specific business endeavor, such as a real estate development. Individuals, general and limited partnerships, and corporations may participate. A joint venture may broker real estate, provided the co-venturers are duly licensed. 5.3 B. A single employing broker who has an active broker's license. Only a broker with an active broker's license can hire and employ a licensed salesperson. A licensed salesperson may work only for the employing broker and may not work for or receive direct compensation from any other broker. 5.4 C. Offer a property for lease on behalf of the employing broker. A sales agent is only authorized to represent a broker and carry out such duties as the broker may legitimately delegate. Thus, a sales agent does not directly represent the client in a transaction but is rather the agent of the broker and subagent of the client. 5.5 D. The employing broker. Agents can only receive compensation from their employing brokers. Co-op commissions, referral fees, and other compensations always flow through the broker to the sales agent. 5.6 D. $4,940. First calculate the total commission, then the co-brokerage splits, then the agent-broker split. Thus, $380,000 x 6.5% equals $24,700 total commission. $24,700 x 50% equals $12,350 total listing broker share. $12,350 x 40% equals $4,940 agent's share. 5.7 C. $4,278. The total commission is $245,000 x 3%, equals $7,350. The agent gets 65% x $7,350, $500, which equals $4,278. 5.8 C. Complete the signing of the listing. Once the seller signs the listing, the next critical task is to get it signed, thereby making the listing a contract. Some states allow a salesperson to do this, and in other states, the listing must be given to the broker for signing. This result will set in motion the process of marketing the property. The agency disclosures must take place prior to the execution of the agreement. 5.9 b. Present the offer to the seller at the earliest possible moment. When a buyer or tenant makes an offer, the agent must present it to the seller or landlord at the earliest possible moment. If the terms of the offer are unacceptable, the agent may assist the seller in developing a counter-offer. 5.10 c. The broker has illegally converted security funds for business use. Conversion is the act of misappropriating escrow funds for the broker's business or personal use. Conversion carries serious consequences, including license revocation. 5.11 d. Never. All advertising must reveal the identity of the broker. Licensed brokers and agents may not use blind ads that conceal their identities. 5.12 a. Fair trade and antitrust laws. Brokerage companies, like other businesses, are subject to antitrust laws designed to prevent monopolies and unfair trade practices. In real estate brokerage, the primary manifestations of unfair trade practice are collusion, price fixing and market allocation. In this instance, the brokers are price fixing. 5.13 b. Outside brokers assist a listing agent in procuring a buyer. Most listing agreements provide for brokerage cooperation in the multiple listing clause. A transaction involving a cooperating subagent is called co-brokerage. In a co-brokered transaction, the listing broker splits the commission with the co-broker, typically on a 50-50 basis. 5.14 d. Only members of the National Association of Realtors registered. The term Realtor registered is a protected trade name of the National Association of Realtors registered. Only members of this organization may use the term to refer to themselves. 5.15 a. Represent their employing broker in procuring clients and customers. Agents may only act on behalf of their broker. They may not assume responsibilities for other listings since listings are not transferable. 5.16 a. The IC is responsible for his or her own taxes, the broker does not withhold. Generally, a broker has limited control over the actions of a contractor. Specifically, a broker can require performance results, but is limited in demanding how a contractor performs the work, and the broker does not take responsibility for a contractor's income and Social Security taxes. 5.17 b. Competitive conditions. Commission structures are negotiated between the agent and employing broker as a function of competitive market conditions. 5.18 c. Avoid disclosing what price the owner will accept. An agent must be extremely careful at this point to abide by fiduciary obligations to the client, whoever that party may be. Discussions of price are particularly delicate. Whether the client is buyer or seller, the agent's duty is to uphold the client's best interests. Thus, it is not acceptable to suggest to a customer what price the client will or will not accept. 5.19 d. Mixing escrow funds with the broker's operating funds. Commingling, a prohibited activity, is the act of mixing the broker's personal or business funds with escrow funds. 5.20 A. There is insufficient evidence of anything other than a normal business practice. Charging identical commission rates in itself is legitimate. Price fixing occurs when competitors have in fact colluded together to set prices. 5.21 C. All the obligations and promises are performed and the transaction is closed. An executory contract is one for which the signatories have yet to perform their respective obligations and promises. Upon closing, the sale contract is fully performed and no longer exists as a binding agreement. 5.22 A. Use a standard contract promulgated by a state agency or a real estate board. It is advisable, and legally required in most states, for a broker to use a standard contract form promulgated by state agencies or real estate boards, as such forms contain generally accepted language. This relieves the broker of the dangers of creating new contract language, which can be construed as a practice of law for which the broker is not licensed. 5.23 B. Be written. A contract for the sale of real estate is enforceable only if it is in writing. A buyer or seller cannot sue to force the other to comply with an oral contract for sale, even if the contract is valid. 5.24 A. The contract has been legitimately cancelled and is null and void. To be valid, a contract must meet the criteria of competent parties, voluntary act of good faith, mutual consent, legal purpose, and valuable consideration. The buyer broke the mutual consent requirement by opting out before being told of the seller's acceptance. Thus, there is no valid contract. 5.25 C. An offer and acceptance. A contract of sale is created by full and unequivocal acceptance of an offer. Offer and acceptance satisfy the mutual consent requirement for a valid contract. The offeree must accept the offer without making any changes whatsoever. 5.26 D. Equitable title. A sale contract gives the buyer an interest in the property that is called equitable title, or ownership in equity. If the seller defaults and the buyer can show good faith performance, the buyer can sue for specific performance, that is, to compel the seller to transfer legal title upon payment of the contract price. 5.27 B. A condition that, if unmet, renders the contract unenforceable. A contingency is a condition that must be met before the contract is enforceable. If one party cannot meet a contingency condition by a specified deadline, the other party may cancel the contract. 5.28 C. The buyer may be able to have the contract cancelled. The termite inspection clause is a contingency clause. If one party cannot meet a contingency condition by a specified deadline, the other party may cancel the contract. Did the clause state that the inspector had to be properly licensed? If so, the buyer has a good case for cancellation. 5.29 A. Until the seller communicates acceptance of the offer. An offeror may revoke an offer for any reason prior to communication of acceptance by the offeree. 5.30 B. Fred has entered into contracts with both Jack and Sally to sell the same property. Jack's acceptance of Fred's offer creates a valid contract, just as Fred's acceptance of Sally's offer creates a valid contract. Fred should have revoked his offer to Jack before accepting Sally's offer. 5.31 D. Agency relationships and property condition. It is common for the seller to disclose the property condition requiring the buyer to acknowledge receipt of the disclosure. The broker discloses the applicable agency relationships in the transaction and names the party who must pay the brokerage commission. 5.32 B. Valuable consideration and a right to buy. An option to buy is an enforceable contract in which a potential seller, the optioner, grants a potential buyer, the optionee, the right to purchase a property before a stated time for a stated price and terms. In exchange for the right of option, the optionee pays the optioner valuable consideration. 5.33 A. Schmidt must sell to Carboy for $10,000. Mary's option to buy contract is enforceable, assuming she paid a consideration for it. 5.34 D. It is always assignable unless the contract prohibits assignment. A real estate contract that is not a personal service contract can be assigned to another party unless the terms of the agreement specifically prohibit assignment. An option to buy is therefore assignable in the absence of such a prohibiting clause. 5.35 C. At the end of the contract period, the vendor conveys legal title, provided the vendee has fulfilled all obligations. A contract for deed is a bilateral agreement between a seller, the vendor, and a buyer, the vendee, in which the vendor defers receipt of some or all of the purchase price of a property over a specified period of time. At the end of the period, the buyer completes payment to the vendor of the full purchase price and the vendor deeds legal title to the vendee. 5.36 B. The parties have completed a verbal, executory contract. As a sale contract created by an offer and acceptance, the parties have an executory contract. The parties have yet to perform their respective obligations and promises. However, as a contract for the sale of real estate, this verbal contract is not enforceable. An enforceable real estate sale contract must be in writing. 5.37 C. The assignor has completed a legal action. Either party to a sale transaction can assign the sale contract to another party, subject to the provisions and conditions contained in the agreement. 5.38 D. Any conveyance may trigger an acceleration of any loan secured by the property. The mortgage agreement may or may not state that the seller's loan will be accelerated by the lender and called due on sale. The due on sale clause in the sale contract merely stipulates that the buyer and seller recognize the possibility that loans that survive the closing may be called due. 5.39 D. The option is expired, and the tenant has no rightful claim to money paid for the option. The option automatically expires at the end of the option period. The landlord has no obligation, either to sell the property or to return the consideration, after the expiration date. 5.40 C. the seller retains legal title while the buyer makes partial payments until the contract is fully executed. In a contract for deed, the seller, or vendor, defers receipt of some or all of the purchase price of a property over a specified period of time. During the period, the vendor retains legal title and the vendee acquires equitable title. At the end of the period, the buyer pays the vendor the full purchase price and the vendor deeds legal title to the vendee. National Test 6, Economics, Appraisal 6.1, b. Demand for the item is increasing in relation to supply of the item. In a market economy, the primary interactions between supply, demand, and price are, if supply increases relative to demand, price decreases; if supply decreases relative to demand, price increases; if demand increases relative to supply, price increases; and if demand decreases relative to supply, price decreases. 6.2 d. Supply and demand are equal, and price and value are equal. A market tends toward a state of equilibrium in which supply equals demand, and price, cost, and value are identical. According to this principle, market demand moves to meet supply, and supply moves to meet demand. If there is an extreme shortage of an item for which there is normally a strong demand, suppliers will rush to increase production to close the gap. If inventories of an item are very high, suppliers will stop production until the oversupply has been depleted. 6.3 c. The uniqueness of every parcel. In comparison with other economic products and services, real estate has certain unique traits. Traits of real estate include inherent product value, uniqueness of every property, demand must come to the supply, illiquidity, slow to respond to changes, and a decentralized local market. 6.4 d. Prices rise. If demand is increasing and a moratorium slows supply, demand will begin to outpace supply, forcing prices to rise as the product becomes scarcer in relation to demand. 6.5 b. An increase in demand for all types of real estate. New businesses will arise to support the new company. They will hire new employees, some from out of town. The new employees will need housing. Hence the demand for residential real estate, as well as for commercial and industrial, will intensify, and it will also stimulate new construction. 6.6 d. The number of available units that become occupied over a period of time. Absorption is the amount of available property that becomes occupied over a period of time. 6.7 a. Rising prices. Within the business cycle of real estate, declining vacancy indicates a combination of increasing demand which fills up supply which in turn decreases. As space becomes scarcer, rents for available space increase. 6.8 b. Desire, utility, scarcity, and purchasing power. The value of something is based on the answers to 4 questions. How much do I desire it? How useful is it? How scarce is it? And am I able to pay for it? 6.9 b. Will increase. If there is no longer a supply to meet the increasing demand of a growing population, prices for existing supply will rise. 6.10 D. The market tending toward equilibrium. A market tends toward a state of equilibrium in which supply equals demand, and price, cost, and value are identical. Thus, if supply is scarce, construction will increase to stabilize the imbalance. 6.11 C. The market is oversupplied. Falling prices indicate an oversupply of commercial properties in relation to demand. In this case, construction of new supply will also slow down. 6.12 A. Have been increasing. A rise in prices is a market signal that there is an undersupply of product in relation to demand. As the market moves toward equilibrium, builders construct more buildings to meet the unmet demand. 6.13 C. It is often difficult to convert to cash. Since real estate is often a large, long-term investment that has no exact duplicate, the process of a buyer's evaluating and choosing the right property is long and complex. Hence, finding a buyer at a desired price can take a long time. 6.14 B. The number of persons employed in base industries in an area. Base employment is the number of persons employed in the base industries that represent the economic foundation of an area. It is the driving component of total employment, which includes secondary and support industries, and which creates demand for all types of real estate. 6.15 D. The total existing space of a certain type that is unoccupied at a given time. Vacancy is the amount of total real estate inventory of a certain type that is unoccupied at a given time. It is often stated as a percentage of total inventory, the vacancy rate for that property type. 6.16 A. Local government influencing the real estate market, regardless of demand. Local governments sometimes declare a moratorium on new construction because of present or projected inadequacies of the infrastructure, water, sewer, power, roads, etc., or because of the desire to conform to a master plan. The result may be to drive up prices, as supply cannot freely increase to meet demand. 6.17 C. In and out migrations of major employers. Changes in employment numbers in a local market area, especially in major industries, have a direct impact on real estate demand in the area. Money supply, interest rates, and trade imbalances also have an impact, but they are regional or national factors rather than strictly local. 6.18 B. Vacancy rises and prices fall. New construction generally occurs to meet an excess of demand. By adding supply, it tends to increase vacancy and lower prices until supply-demand equilibrium is achieved. 6.19 D. Residential. While all types of users may have these needs, they are most prominent for residential users because of concerns for family comfort and safety. Retail users are more concerned with competitive features of the trade area. Office users care more about occupancy costs and suitability for the business. Industrial users care more about such features as functionality, accessibility, and the labor pool. 6.20 C. Its susceptibility to swings in the local economy. Because a real property cannot be transferred to a large, central real estate marketplace, its marketability is closely tied to local conditions. Investors and users must come to the product, unlike other types of economic product that can be moved to a place in search of greater demand. 6.21 b. Anticipation. Anticipation is the value principle that a buyer will pay a price based on the benefits the buyer expects to derive from a property over a holding period. For example, if an investor anticipates an annual rental income from a leased property to be $1 million, this expected sum has a direct bearing on what the investor will pay for the property. 6.22 b. A homeowner adds a third bathroom to a house and thereby increases the appraised value by $10,000. The principle of contribution focuses on the degree to which a particular improvement affects market value of the overall property. In essence, the contribution of the improvement is equal to the change in market value that the addition of the improvement causes. For example, adding a bathroom to a house may contribute an additional $15,000 to the appraised value. Thus the contribution of the bathroom is $15,000. 6.23 a. Assemblage. Assemblage, or the conjoining of adjacent properties, sometimes creates a combined value that is greater than the values of the unassembled properties. The excess value created by assemblage is called plottage value. 6.24 d. Market value is an estimate. Market price is the price at which a property sold. Market value is an estimate of the price at which a property will sell at a particular time. The market price, as opposed to market value, is what a property actually sells for. Market price should theoretically be the same as market value if all the conditions essential for market value are present. Market price, however, may not reflect the analysis of comparables and of investment value that an estimate of market value includes. 6.25 d. Define the appraisal problem and the purpose of the appraisal. The first step in the process is to define the appraisal problem and the purpose of the appraisal. This involves identifying the subject property by legal description, specifying the interest to be appraised, specifying the purpose of the appraisal, specifying the date for which the appraisal is valid, and identifying the type of value to be estimated. 6.26 c. Weighing the applicability of the approaches and considering the quality of data supporting each approach. The final step in the appraisal process is to reconcile the value estimates produced by the three approaches to value into a final value estimate. To do this, an appraiser must weigh the appropriateness of a particular approach to the type of property being appraised and take into account the quality and quantity of data obtained in each method. 6.27 b. Make dollar adjustments to the sale prices of comparable properties to account for competitive differences with the subject. The sales comparison approach consists of comparing sale prices of recently sold properties that are comparable with the subject, and making dollar adjustments to the price of each comparable to account for competitive differences with the subject. After identifying the adjusted value of each comparable, the appraiser weights the reliability of each comparable and the factors underlying how the adjustments were made. The weighting yields a final value range based on the most reliable factors in the analysis. 6.28 D takes into account the competitive value of specific amenities of the subject property. The sales comparison approach is widely used because it takes into account the subject property's specific amenities in relation to competing properties. In addition, because of the currency of its data, the approach incorporates present market realities. 6.29 A adds value to a comparable that is inferior to the subject property. If the comparable is inferior to the subject in some characteristic, an amount is added to the price of the comparable. If the comparable is better than the subject in some characteristic, an amount is deducted from the sale price of the comparable. This neutralizes the comparable's competitive advantage or disadvantage in an adjustment category. For example, a comparable has a swimming pool and the subject does not. To equalize the difference, the appraiser deducts an amount, say $6,000, from the sale price of the comparable. 6.30 B requires the fewest and smallest adjustments. As a rule, the fewer the total number of adjustments, the smaller the adjustment amounts, and the less the total adjustment amount, the more reliable the comparable. 6.31 C. $195,000. Since the comparable has an extra bath, it is adjusted downward to equalize with the subject. Conversely, since it has no patio, the appraiser adds value to the comparable. Thus, $200,000 minus $7,000 plus $2,000 equals $195,000. 6.32 D. Add the estimated land value and cost of improvements and subtract the accrued depreciation of the improvements. The cost approach consists of estimating the value of the land as if vacant, estimating the cost of improvements, estimating and deducting accrued depreciation, and adding the estimated land value to the estimated depreciated cost of the improvements. 6.33 B is very accurate for a property with new improvements that represent the highest and best use. The strengths of the cost approach are that it provides an upper limit for the subject's value based on the undepreciated cost of reproducing the improvements. It is also very accurate for valuing a property with new improvements which are the highest and best use of the property. 6.34 C. A property loses the same increment of value each year over the economic life of the property. All property improvements have an economic life, which becomes incrementally shorter year after year as physical deterioration takes its toll. The property as a whole does not lose value, since land itself does not depreciate. Similarly, an improvement can regain value if it is repaired or updated. Finally, not all properties lose value from economic obsolescence. 6.35 D. $115,000. To appraise value using the cost approach, add the land value to the value of the depreciated improvement. Thus you have $30,000 plus $95,000 to $10,000, or $115,000. 6.36 B. divide the income a property generates by a rate of return. An appraiser obtains an indication of value from the income capitalization method by dividing the estimated net operating income for the subject by the rate of return, or capitalization rate. The formula is NOI/cap rate equals value. 6.37 C uses a method that is also used by investors to determine how much they should pay for an investment property. The strength of the income approach is that it is used by investors themselves to determine how much they should pay for a property. Thus, in the right circumstances, it provides a good basis for estimating market value. The approach, however, does not project what an income property's future income will be. Moreover, it is not an applicable method for estimating value if the subject is a non-income producing property. 6.38 A. $370,000. First, identify net income by subtracting out vacancy and expenses. Then divide by the capitalization rate. Thus, $60,000 to $3,000, $20,000, divided by 10% equals $370,000. 6.39 D. 150. The monthly gross rent multiplier for a property is equal to the price divided by the monthly rent. Thus, $450,000 divided by $3,000 equals 150. 6.40 C. $203,000. Multiply the monthly gross income times 12 to derive annual income. Multiply annual income times the gross income multiplier to derive the estimate of price. Thus, $1,200 times 12 equals $14,400. This times 14.1 equals $203,040, or $203,000 rounded. 6.41 C. The state in which the appraiser operates. A state-certified appraiser is one who has passed the necessary examinations and competency standards as established by each state in conformance with the federal standards. 6.42 A. The Financial Institutions Reform, Recovery, and Enforcement Act, FIRREA. Title 11 of FIRREA requires that competent individuals whose professional conduct is properly supervised perform all appraisals used in federally related transactions. As of January 1, 1993, such federally related appraisals must be performed only by state-certified appraisers. 6.43 A. If two similar properties are for sale, a buyer will purchase the cheaper of the two. According to the principle of substitution, a buyer will pay no more for a property than the buyer would have to pay for an equally desirable and available substitute property. For example, if three houses for sale are essentially similar in size, quality, and location, a potential buyer is unlikely to choose the one that is priced significantly higher than the other two. 6.44 A. Is physically and financially feasible, legal, and the most productive. This valuation principle holds that there is, theoretically, a single use for a property that produces the greatest income and return. A property achieves its maximum value when it is put to this use. The use must however be legal. 6.45 d. $200,000. Market value is an opinion of the price that a willing seller and willing buyer would probably agree on for a property at a given time. If the transaction is for cash, the property is exposed on the open market for a reasonable period. Buyer and seller have full information about market conditions. There is no abnormal pressure on either party. It is an arm's length transaction. Title is marketable, and the price does not include hidden influences such as special financing deals. The amount Lynn actually paid is the market price. The previous listing price and Ken's offer might be interesting data for the appraiser, but the appraisal must also consider other market data, such as comparable sales. 6.46 a. There may be no recent sale price data in the market. The sales comparison approach is limited in that every property is unique. As a result, it is difficult to find good comparables, especially for special purpose properties. In addition, the market must be active, otherwise, sale prices lack currency and reliability. 6.47 c. Selects comparable properties, adjusts the comparables, and estimates the value. The steps are to first identify comparable sales, then compare comparables to the subject and make adjustments to comparables, then, finally, weigh values indicated by adjusted comparables for the final value estimate of the subject. 6.48 b. The seller offers below-market seller financing. The principal factors for comparison and adjustment are time of sale, location, physical characteristics, and transaction characteristics. An adjustment may be made for such differences as mortgage loan terms, mortgage assumability, and owner financing. 6.49 b. Weights the comparables. The last step in the approach is to perform a weighted analysis of the indicated values of each comparable. The appraiser, in other words, must identify which comparable values are more indicative of the subject and which are less indicative. However, all comparables are taken into account, not simply the nearest comparable. 6.50 b. Market value is not always the same as what the property cost. The limitations of the cost approach are that, the cost to create improvements is not necessarily the same as market value, and depreciation is difficult to measure, especially for older buildings. 6.51 b. Replacement cost. Reproduction cost is the cost of constructing, at current prices, a precise duplicate of the subject improvements. Replacement cost is the cost of constructing, at current prices and using current materials and methods, a functional equivalent of the subject improvements. 6.52 d. Functional obsolescence. Functional obsolescence occurs when a property has outmoded physical or design features which are no longer desirable or acceptable to current users. 6.53 b. Incurable economic obsolescence. Economic, or external, obsolescence is the loss of value due to adverse changes in the surroundings of the subject property that make the subject less desirable. Since such changes are usually beyond the control of the property owner, economic obsolescence is considered an incurable value loss. 6.54 C. Depreciation. Depreciation is the loss of value in an improvement over time. The loss of an improvement's value can come from any cause, such as deterioration, obsolescence, or changes in the neighborhood. 6.55 A. Estimates depreciation, subtracts depreciation from cost, and adds back the land value. The steps in the costs approach are: 1. Estimate land value, 2. Estimate reproduction or replacement cost of improvements, 3. Estimate accrued depreciation, 4. Subtract accrued depreciation from reproduction or replacement cost, and 5. Add land value to depreciated reproduction or replacement cost. National Test 7.